All right, Brad. Well, welcome to the show. I appreciate your time.
Thank you for having me, Kirk. It's great to be here.
Yeah, and it's really timely that you're going to be on because with the new Inflation Reduction Bill adding 87,000 potentially IRS agents, tax planning is going to become a bigger and bigger part of people's lives, and you've got a really unique offering that I've had clients of mine use and been extremely happy with. So I just wanted to kind of get the word out there to other people so they can kind of understand what the iClad is and how it could help them out. So I'm gonna like throw it right over to you. I know you have some slides,
Sure.
and we'll kind of jump in and just talk a little bit about it.
Well, that sounds great. And as I pull up my slides, you're spot on with the whatever they're calling the act these days, the Inflation Act, the Climate Act. But yeah,
Yeah,
87,000. I mean, they're justifying the expense of this bill and the spending with um, the additional funding to the IRS, and it's more than just 87,000 agents, and that's like a football stadium. That's mind-boggling. It's like a
yeah,
small army. So yeah, this is a pretty common for the right clients. This is a very uh, uh, compelling strategy for folks, and timely as well as interest rates are rising. So let me pull up my slides and shut up and see if I can get it working here. Okay, share. Hopefully this works. Yes? Can you
yep.
see
We're
it?
good.
All
We
right.
are good.
All right.
Yes.
Well, the tool is called the iClat, and that's what our company is referred to. This is the name of this vehicle, but it's been around for a long time. It's just iClat is simpler to use, and it kind of conveys the value of it. And really, it's just an immediate income tax saving strategy. And these slides I give at presentations, this will be more of a conversation than me kind of just doing a monologue here. But the key idea with this tool, and it'll help explain who this applies to. The key idea with this tool is it gives income tax savings now for folks' future annual gifts to charity. So anyone who is part of their financial plan, part of their lives, they support their place of worship, their church, their alma mater, maybe their kids are involved in their philanthropy. Anyone who's already giving $10,000 to $100,000 a year, that's kind of the first demographic or type of clients in a situation where this tool really applies. And this is all it is. If we don't remember anything, it's just think about it as income tax savings now for future annual gifts to charity. That's what the iClat does. And what it is can be best answered by 4 questions. This is everyone says, okay, Brad, we're all busy. What is it? How does it save taxes? Who's ideal for it? And why is now the time for it? So we're just going to jump in if that sounds good to you, Kirk.
That's perfect.
Okay. Um, well, what is it? This is where I'll spend a limited amount of time because this sometimes will be talked about to advisors and other CPAs. This is very important for your clients because obviously they have valuable other advisors on their team. And a lot of times they want to say, well, okay, what are we talking about here? So
Yeah.
this is the technical stuff. It's a charitable trust. It makes annual distributions to one or more charities for a specified number of years, whether that's 3 years, 10 years, 20 years, certain defined number of years. And then at the end of the term, the trust assets just come right back to the client. Very few trusts do that. Usually when people set up trusts, they'll put money in and it goes to family at some time. Here, we're using this trust for a limited period of time, and the assets are going to return back to your client. So that's important. The technical name is a reversionary charitable lead trust that is treated as a grantor trust for income tax purposes. I think iClat is a lot easier to say than that, but
Yeah.
for the advisors who want to maybe share these slides, and I'll be happy to send these to you for any of your clients or people in your community of colleagues and other advisors who are interested in looking at this as well. But that's what it is, and there's the code and the regs. So let's talk about what it is in a different setting. Some people are more visual. And some advisors and some clients have heard of a charitable lead annuity trust before, and they've had a bad experience. That's because most charitable lead trusts, and if you Google a charitable lead trust, the analogy is you're talking about, a Ferrari. I mean, you're talking about a very, very complex, expensive, and quite frankly, risky to the extent that it draws attention. You drive a Ferrari around even under the speed limit. Sometimes you might get just pulled over because of the type of vehicle you're driving. Most charitable lead trusts that families do have a blended purpose of not only income tax savings, but estate tax savings. And when you get into estate tax savings and saving millions and millions of dollars of future estate taxes and generation skipping taxes, that's a more powerful vehicle. But that's not what we're talking about today, because very few people need that, just like very few people need a Ferrari. And the people sometimes don't even want a Ferrari. So I use this slide to explain where we are. That's still a beautiful blue car over there, but it's actually a Lexus. Maybe I should put a more simple car like a Camry or a Accord. That's kind of where the iClat sits. It's much more basic and much more applicable to folks, because more folks just need income tax planning. So hopefully that analogy works. Nothing against all the people that own Ferraris, but just a visual way of explaining the unique aspect of what we're talking about, particularly for folks who want to go Google charitable lead trust. 95% of the stuff on the internet does not apply to this lesser used, simpler vehicle.
Okay.
So let's look at the structure. The structure, there's three stages of an iClat. So Kirk, let's assume you have a client and they give some money to charity. What are we talking about here? Well, this iClat involves your client setting up a trust. Always, your client is going to be the trustee. And what this looks like usually is they'll have an account with you or their bank, and or you're starting to work with them. And the idea is you're going to set up a new account, and it'll be the trustee, the person who's in control of that account, will be the client. So there's that maintained control. They're investing the assets or using you to invest the assets. They can buy and sell just like always. So they're gonna allocate certain assets to a trust, and then for the defined period of time, the only thing really coming out of that trust for 5 years, 10 years, 20 years are the annual payments that they like to give to charity. They can pick the charities, change them, have it go to a donor advised fund or a private foundation. A lot of flexibility there. But of course, during that time, these assets are growing, are invested to grow. Obviously, over a period of time that you would expect there to be growth, even if we have 1 or 2, bad years or whatever. These assets are still over here. So what happens to these assets at the end of the term? Well, Kirk, as you know, with the clients that we've done this with, at the end of the term, I don't know why there's little white specks here, but in any event, it looks like the arrow's cooler that way. But anyway, at the end of the term, the assets will come back to the client. And that technical term that I used in that other slide of a grantor trust, it's a non-taxable transaction. So if you put this in stocks, equities, mutual funds, or even real estate, and it's gone up in value, well, when those assets come out in kind, and let's just stick with marketable securities, they're going to come back and go back into the client's main account or joint account or revocable trust account in a non-taxable transaction. So it's not disruptive at all. But that's kind of the nuts and bolts of what it looks like.
Okay. So when that money reverts back, the reversionary part of it, they keep the cost basis, so they don't get taxed on the gains at that time. But if they sell the following year, then they might have capital gains tax.
Yes, that's exactly right. And I have an example in a few slides. And if we'll talk about what happens from an income tax perspective, because obviously those assets are generating interest, qualified dividends, you're buying and selling assets. During the term, someone's got to pay income taxes on that, and we'll talk about that in a few minutes. In a second, but to the extent the assets are left alone or they just have passive capital appreciation, when those come out, yeah, there'll be historical cost basis in the client's
Okay.
account where those assets go.
And,
So
and then one
go ahead.
little other question. So let's say that, they have a charity that they like, that they consistently give to, but if that, for whatever reason, if that charity or nonprofit starts doing things they don't agree with, or they don't believe in the mission anymore, they can always switch it year to year.
Yep.
Okay.
Yep. I mean, let's say the annual payment's $25,000 a year. One year they could have all 25,000 go to their alma mater. The next year they could have half of it go to their alma mater, half of it go to their church. The next year they could have it all go to an entirely new charity. If they wanted to write, 100 checks for whatever the math is, $25 each.
Okay.
They could do it that way. But as we'll talk about in a minute, there's some easy ways to do that. But your point is well taken. People move, charities lose leadership, and maybe the new leadership. It's not like a irrevocable. It can be irrevocably designated if, for some example, someone has a non-legal. I'm sorry. A non-binding pledge agreement with their alma mater, let's say, where they've kind of in a non-contractual way said, count us in for 50 grand towards the new building, and yeah, we want a plaque and a name on it or something. That's allowed too, and we've done them many times for that. You got to be careful that it's not a legally binding pledge personally, but I don't want to get off on those. So bottom line is there's a lot of flexibility with this, but so 2 words here. How does it save taxes? Present value. I'm not going to spend a tremendous amount of time here, but many of your clients are probably familiar with what present value means. But the whole reason this works is that the iClat gives the client a deduction that's based on present value concepts. And so we've had over a decade of historically low interest rates. And that's the whole reason that you and I are talking. This tool works extremely well when interest rates are low. Now, inflation is here and interest rates are starting to tick up, but they're still historically extremely low. But the deduction is basically simply the present value of those annual payments going to charity using a discount rate of, which we have right now, 3.6%. And the amount of that present value is the deduction your clients will get to mitigate taxes that they otherwise would face this year. We already know in October we're going to tick up to 3.8, and actually in about 5 days we'll get the next monthly rate, and I'm pretty confident it's going to be 4% or 4.2. So there is certainly an incentive to do this now. I'm getting ahead of myself. We'll talk about why now is the important time to look at this. But this is a very important slide. Let's assume we have a client that gives $25,000 a year. That's who they are. I mean, that's a little more than $2,000 a month. A lot of times people who do iClats are very involved with their church or their temple or their other place of worship. So this isn't, not everybody does this, but a lot of people do. So let's take 10 years. That's $250,000. Well, if they use an iClat, they'll get a deduction for $206,000. Okay, and what that is 82% of the $250 that they're promising to give. So you're getting a deduction that's equal to almost 83% of what you're promising to do over 10 years. That's incredibly powerful because they're not writing a check to charity for $206,000. But by no stretch of the imagination are they parting with that amount of assets up front, but the IRS gives you that deduction. For most folks who use this are just continuing to do what they're already doing. Look down here at 25 years. Let's assume that someone is in their 30s or 50s. 30s or 40s, or maybe their 50s, or they're married and the spouse is a little younger. Same concept. $407,000 deduction today for simply continuing to pay $25,000 to your preferred charities each year. Again, the percentage is lower because that's how present value works. I can stop here if you'd like, because this is probably the most important slide, or one of them, because this is really what this thing does. There's no magic to $25,000 a year. But Kirk, did you have any comments here, or anything that you wanted to interject upon?
Well, no, I think the big thing you'll probably hit is like who would really want to be thinking about this,
Yep.
because if you get a tax deduction of between 206 or $407,000, you've got to have a pretty big income or
Yep.
an event take place.
Yep. Yes, absolutely. Not everyone can benefit from this, and so that's a good segue. And this works really good, incredibly well for certain people. It's not for every annual giver, and the way to figure out if this is an ideal tool for you is, you've heard me say this already. You really want to start with someone who's already giving $10,000 or more to charity, and including to their place of worship. DAF means donor advised fund, which many folks use these days for their charitable giving. The annual payments can go to that, or any blend of this. But again, I can't emphasize this enough. If they're already doing this, then this tool is not going to make them do anything that they're not already doing, which is incredibly important when you're making recommendations, because they'll say,
Sure.
well, what are you going to make? What square peg are you going to throw me in now? That that to get this tax deduction, how many jumping jacks do I have to do? So you want to start there. And then there's two categories. There's someone who has a spike income tax event or a big increase this year. That's one class, and we'll talk about that in a second. Or they're making a lot of money now and they're about to retire. Like, take a physician or an executive where, they give $30,000 a year and they never think twice about it because they have so much money. Well, when they're about to retire and live off a muni bond portfolio or some other tax exempt, or just, their income's going to go from like $500,000 to $100,000, and they're going to live off their principal investments, then you want to capture the deduction in the last year that they're making high income. Professional athletes, another good example, but not all of us are professional. I'm not either. But really, your doctors, your lawyers, your professionals, your executives fit ideal scenario number 2 very well. So this is there's a lot here, but some people like visuals. So you have your Venn diagram, and you take your client who gives a 10 grand or more spike income event. I like to start as low as $250,000. That's not a lot. I mean, not everyone has that, but that's kind of the threshold where you start the discussion. I mean, if you had an increase of $100,000, well, when you really pop the hood on this and all the advisors look at it, it's not that compelling. But let's assume someone had a big bonus or a big commission on the sale of a piece of real estate if they're in the commercial real estate business, or they're a lawyer and they got a big old contingency fee on a trial they've been working on, or just a bonus or a great K1 year, or maybe, which is one of our most common, they had a Roth conversion. They converted a IRA to a Roth. Those are the situations where it works best. It can be capital gains. I put ordinary income here because that's the best scenario. So this check mark refers to where I am, Florida, Texas. These are the states that have no income tax. These are the states which other check mark states, if the client is in, let's say, Michigan, they have an income tax in Michigan, but they do not have a charitable deduction at the state level, nor do any of these other states over here. So any client that meets those two demographics, it's a check mark. It works wonderful. But the bullseye is someone who lives in a state with an income tax and a charitable deduction at the state level. And that's all of these. So the biggest ones would be California, New York, Oregon, Iowa, Minnesota, Missouri, the states that have a very high income tax rate, but also give their residents a state tax deduction. So the people that really look at this, and this is the biggest class, this is where you want to be. In our example, we'll cover that. But again, I didn't do another slide in the interest of time. Again, don't forget about number 2. If you are making a lot of money and you're a booster, and you're always going to give that money to your athletic program at your college or your place of worship, it's the same analysis. You're trying to capture that deduction on the tail end of your high income years. That's all this tool is. So why are we talking now? And I said right now because here comes the inflation. This is an example. This tool still works, but it doesn't work as good as interest rates go up. Let's take someone who gives $50,000 per year to charity, and for 10 years. That's $500,000 over 10 years. If they do an ICLAT before September 30th, the deduction will be $413. It'll save them $153,000 today for doing nothing different than what they're already doing. If they fall into, if they have a spike income event and they have enough income, and we'll talk about that in a second. But look what happens when we hit 5%, and we might be at 5% by the end of the year. Oops, didn't mean to do that. It's not drastic, but you see now the deduction's $386 and the savings are $142. This isn't earth-shattering money, but that's real money. At $10,000 is a lot of money. So I'm telling clients, as the interest rates start to go up, and look at 8%, and maybe in 2023 we'll be at 8%. The tool still works very well, just not as well. And now you're saving $28,000 less. So that's just the way I like to illustrate why now is the time to consider this, as opposed to the Thanksgiving weekend as we get to the end of the year, because this will probably be where we are, somewhere between this and this by the end of the year.
Okay.
So I have a quick example, but before I get into that example, you're the financial mind, Kirk, compared to me. I mean, again, there's a little sensitivity here. It's not drastic. It's just minor encouragement. But did you want to add anything there, or do you want me you think we should just get right into the example?
Well, no, I think it comes back. So these things are set every single month. Then is the rate, and going back to what your previous example, the present value of the donation is affected by that rate. So that's why it can fluctuate so much. Yeah, it's so. Yeah,
and when we were talking last year, not to last year the rates were they were basically below 1% the entire year. We had 1% last December and November and October, and this time last year I think we were at 0.8 or 0.6%. So it was more like a 460 deduction. It was just, I think it was more like 440, but again, it still works incredibly well. And this is still a historically low rate when you look over interest rates over the last, 50, 60 years. Sure. So any event, let's look at Peter. This is a real case. Names have changed and all that stuff, but this is a real case. Peter regularly gives $40,000 to his favorite charities, including to his church. He anticipates doing so for the next 12 years. Based on the advice of his financial planner and his CPA, he already decided to convert his $1 million traditional IRA to a Roth IRA. All right, and maybe Kirk can expound on that a little bit more if he likes to, but Peter is a California resident, and he has a donor advised fund. That's one of those charitable funds that people use to make their annual gifts to charity anonymously on their time frame, as opposed to the last week of the year when everything is crazy and no one has time. So let's take a look at this. All right, this is an economic schedule, and there's a lot here. I want to direct everyone's attention to this vertical column, okay? This is the annual payments to charity, okay? $40,000 a year. Remember we said $40,000 a year. So that's over 12 years. That's $480,000. So I want to start here because this is what the deduction is based on. So the present value, and I went ahead and upped the interest rate when we did this, but this is the current rate. When Peter did this, it was a lower rate. But if he were to do it today, the deduction's $354,000, and he's going to be at the top bracket of 37% because of that big Roth conversion, which we'll talk about. Since he's a California resident, believe it or not, that California residents have to pay the top rate of 13% income taxes. So not only did this save him $131,000 on his 1040, depending on where the clients are, they may not see this compelling of a number. But if they're in a state that has an income tax more like 5 or 6%, be a little lower. But look at this: $177,000 of immediate tax savings for moving some of his assets into a new account and simply doing what he's always been doing. So we'll look at this from a 30,000 foot level, but that's the reason he did this. All right, there's a lot here, and I want to talk about the reversion at the end of the term, and we'll talk about what we funded the trust with and why it was only 500 and maybe not a little bit more. But the reversion is the other big benefit, and it was, if this thing were to earn 5% a year for 12 years, then magically, it would magically, meaning fixed rate of return for 12 years, that's not going to happen. Then they would get $261,000 of their money back at the end of the term. There's a lot here. We're going to spend a few minutes on this slide, but what I have over here is I'm taking that big deduction over here of $177,000, and assuming we're investing that money, and it grows. So at the same annual rate of return of 5%, that's $300,000. Would be the benefit of that deduction. So this blue column is talking about the reversion. This is talking about the benefit of that tax savings plus the balance of Peter's ICLAT assets. So this 564 is illustrating hypothetically where he would be at the end of the 12 years with the present, the invested value of his big deduction plus what's ever going to come back to him from the trust at the end of the term. So actually 261, but if you were to, so many of my advisors and CPAs asked me to add these columns, Kirk,
Okay.
because you have to show this to really explain the value of it. So you're really, and this is pretty modest, but this, to your point about income, there's a couple things I want to point out here. This is a very big charitable deduction, Kirk, and as you've mentioned, you need a lot of income. Well, how much income do you need? Well, right here in the middle, you see this: to receive all the income tax savings on his 2022 tax return, his AGI needs to be at least 1.1 million. What is that number? That's the number because the deduction from an ICLAT is, it's not unfortunately, it just is what it is. Their ability to claim it in the current year is limited to 30% of the client's adjusted gross income. So this number is 30% of a client's adjusted gross income if that's their income. Now remember, with Peter, they had $1 million Roth conversion. Of course, Peter had I think it was like $180,000 of other income. So we reverse engineered this specifically so that he could pretty much write all of this off in year one. But that would be the income, and to your very valid point, you need a lot of income, hence the spike event that we talked about earlier. But if they can't deduct that, or if the income ends up being less, then there's a 5-year carry forward for that deduction. There's more here on this, and we'll talk about the funding in a second, but that's very important. So,
So
this
so
is kind
how
of,
so let's. Sorry, I don't mean to cut you off, but
Yeah.
let's say you have a client. They typically give 40,000 a year.
Yep.
They're not at that 1.1. So do you ever look to do one of two things? The Roth conversion is a great example that you talk about. So if somebody's kind of borderline, most people have been putting money into 401k or IRAs for their working life, so they Roth conversion. So it gives them an opportunity to get some tax savings there. Or do you just kind of bring down the amount of the ICLAT to maybe 25,000, and then they just give 15,000 a year each year
Absolutely.
on their own outside of it?
That's how we do it. We have an intake process, and basically we start with their comfortable level of annual giving. and then we take what their AGI is. There's a little moving parts here, but it's really not that complex. If Peter's AGI was going to be at like 600,000 instead of this, then all we would have done is, instead of this being a 12-year ICLAT, we'd make it like a 8-year ICLAT or a 6-year ICLAT. And because there's less payments involved, then the deduction's a little smaller.
Okay.
You understand what I'm saying? I mean, that's kind of how you reverse engineer it.
Okay. So you reduce the number of payments rather than just necessarily the amount that they.
Yeah, yeah, exactly. You could
Okay.
either reduce the annual amounts or shorten the term, and that's why it's just always so much. Once we know what the annual level of giving is anticipated, and particularly those in the faith-based community, and I just noticed a little typo up here. This says 15 and it's 12, so that's a typo. It's 12 years for this term,
Okay.
but in any event, for folks who know, I mean, particularly if their faith, their giving is a huge part of their faith. Even if they have some bad years, we kind of say, what are you comfortable that you're going to be giving? They might actually give $70,000 a year of charity. They could still give that out of their personal money, but what the ICLAT's designed to do is kind of capture the amount that they're really comfortable that this is, because they do need to give that annual money to charity, that annual amount. Let me shift gears quickly to what we need to fund this with, and this is a common question. A lot of people say, "Oh, I get it now. I can't fund this willy-nilly. I mean, I got to put all the money in advance." Is that right, Brad? And I say, yeah, you do. And notice how this number's $500,000. Really savvy clients and advisors will say, okay, Brad, I get it. If we put more money in here, then we'll get more money back at the end, right? I go, absolutely. I mean, we could put $1 million in here and the illustration looks a heck of a lot cooler, because now they're going to get probably, the illustration would probably be, they're going to get 1.2 million back at the end of the term, and they're going to get all their money back. But a lot of savvy advisors and clients will say is, okay, Brad and Kirk, I get this, but all things being equal, what's the minimum amount I reasonably need to put in this thing to get that deduction? Because all things being equal, and I don't think I mentioned any of this yet, so I'm sorry, I know we're doing a condensed discussion here. Whatever you put in the ICLAT, you got to leave it alone. You can't live out of this money, okay? Mm-hmm. You can invest it, you can buy and sell it, you can go from real estate to cash to marketable securities. You still control it, but you're not you're not buying stuff with your iCloud. You're not borrowing against it. So what a lot of savvy clients and advisors say is, okay, all things being equal, I'd like to keep that excess money in my left pocket where I can use it for whatever the heck I want, and the IRS isn't going to be looking at me if I access that principal. And a lot of folks like that. And so that's why this doesn't look that compelling. Only 261 coming back. Where's my 500? That type of thing. But the idea is that extra wealth, they have full control over. But the answer to that question, what's the minimum reasonable amount I need to put in this thing? Quite frankly, you could fund this and get a $354,000 deduction by funding it with as little as $354,530. The deduction that an ICLAT is going to generate can never be more than what you fund it with on day one. That would be very risky. When I say risky, I mean, I would never advise someone to do it right to the penny minimum amount. So what I typically do in connection with the advisor, the financial planner, the CPA, is let's take the sum of the payments and maybe add $20,000, $30,000 to it. So if we have some horrible years, investment-wise or whatever, there's plenty of assets there. Kirk, I'm kind of rambling there, and maybe not rambling. Does that make sense?
Yeah, absolutely.
When you get to the planning stage, that's very important, and so that's really where the design and work goes into this to customize it for the client. But go ahead, Kirk, you were going to say something.
Well, no, I guess so. Talk about your last point. If you didn't put enough in, and markets work against you, like a 2002 bear market 3 year, I assume there's some pretty stiff IRS penalties if the eventual proceeds out of the ICLAT don't match what
Well,
the
it's a
present
great
value.
question. Yeah, it's certainly not a good event if you run out of money, and we could spend a lot of time here, but it's not, there's no penalty, okay?
Okay, okay,
If you play by the rules. You'll either have to fund it with some more money, or you collapse it and have what's called recapture of
Okay.
part of that deduction you didn't take. But if you do it right, the penalties aspect of your comment, there's no penalties. But let's just spend one more minute in this area. Let's assume we put everything in a horrible stock, which is not going to happen with your clients, and it just absolutely collapses. Let's say one day, we've put it in, it's 500, and we get to year 4, and there's only $100,000 in the account right now. Okay, that's obviously not a good fact, but that alone is not a problem. Okay, because that 100,000 could, for all the IRS knows, or whoever we know, that 100,000 could turn into $1 million if the market just skyrocketed, or it's the next Tesla stock, or
okay,
maybe Tesla's a bad example. All the IRS cares about with this type of vehicle, and we're not doing estate planning, and this is where this tool is really good compared to all the others, because if that value goes down to 100, as long as we're making that $40,000 payment, we're good. Of course, there'll be less coming back to the client at the end of the term, but that would have been the case if they never did the ICLAT and their assets tanked. But it begs the question, okay, what about that year where we got to make 40 and there's only $10,000 in the account? Well, that's where the decision comes in, whether you collapse it or you put another 100 grand in there, or 30 grand to, that's where it gets really, there's some different options to do.
Okay.
If you did fund it with more money, you would not get an additional charitable deduction. But I just use that to explain, if it doesn't have all of the money in for all of the payments, of course the market could come back. At the end of the day, I'll also say this. Let's assume the guy put, the 500 grand under his mattress, okay, in an envelope saying this 500 grand is owned by my ICLAT or whatever. And each year he just gives $40,000 to charity. Well, of course, there's no growth on that money, and forget about inflation, but if you put in 500 and 480 of cash is going out, he'll have $20,000 at the end of the year. And that's perfectly fine. So that's what I use that example. No one's going to do that.
And you are using 5% interest rate, it hopefully is a conservative estimate for a diversified portfolio. We hope.
Yeah, obviously for the particular client, we can go lower or higher. One last thing I'll say too, and this is very important. I mentioned this earlier. I talked about who's paying the income tax on these investments during the 12 years. And that's why I break up the 5% into net income and growth. So this, Kirk, and most of your clients probably will, but this is dividends, interest, rents, and royalties. So this is passive growth, the market going up and down. So the bottom line is whatever is in this column, okay, interest, qualified dividends, rents, royalties, recognized capital gains, whatever is in this column, someone's got to pay tax on it. So who's paying tax on this? And the answer is your client. Just like they got the charitable deduction in year 1, this trust is ignored for income tax purposes. That's why they get the big charitable deduction. Just like a revocable trust, your clients probably have a lot of revocable trusts. You probably have a lot of clients that have those. When the 1099 on this account goes out, that number is going to be paid and picked up on the 1040 for the client. So this is not a tax-free vehicle by any stretch of the imagination. It's very important. That's about as technical as it gets. Whatever's in this column will be reported, and the CPA will understand this on the 1040. Just like because if they never did this, they'd be doing that income. They would also be paying on their 1040 anyway. So
Okay.
It's just a continuation of what they've always been doing. Of course, if they wanted to invest the iCloud assets in municipal bond portfolio or tax exempt of course they're not paying, no one's paying income tax on that, but
Okay.
that's very important. And sometimes we'll get these illustrations really, really, engineered, because mine are rather, there's not a lot of Monte Carlo analysis in my little plain vanilla illustrations here, but
No, but that's good. I think clients probably prefer to see something like that.
yeah, but
So basically, a lot of people think you set up this trust, all the taxes are handled within the trust. That's not the case. It's coming back to them. So what would be the I guess income tax? What steps do people have to take during the year? Is there a special tax return, or they just get the 1099 and that's
oh, great
that?
question. Yeah, great question. The this vehicle, the iCloud, it does have a tax ID number because it's one of these charitable trusts that gets kind of special treatment. The CPA, the only administration cost of this, other than investment fees and whatever they're paying the advisors and stuff, they will have to pay their accountant or tax preparer to prepare 2 forms each year. They don't pay our company. We don't charge some annual fee on this. But they're 2 returns. One is a very simple, what's called a Form 1041, but it's a grantor trust Form 1041. And all the accountants that hear this, that's a simple return. You just check a box and say, "Dear IRS, everything under this, all the income, loss, blah, 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 capital gains under this EIN number is going to be reported under code section blankety blank on the client's 1040 under this social security number." So that's like a 15-minute return to prepare. Okay, not a lot of work there.
Okay.
The other form, but just like they get W-2s and 1099s and K-1s, that's just another item. The iCloud's 1099 is just another item that needs to be reported on their 1040. The other return is called a 5227. That's a little more involved. It doesn't pay any tax. That's a form where you report to the IRS that you followed all the rules. These are the charities that got the annual money, and there's a balance sheet page that shows the assets that are in the lead trust, because the IRS wants to make sure, this is the way they just make sure that you're not playing games, or you're not. There's also questions about whether you're a terrorist or you're funding foreign charities, and you're not breaking the private foundation rules. You're not using this money to secure a personal loan. And sometimes with clients who are developers and they have personal guarantees all over the place, that is very important rule that they have to understand. So the 5227 is the form that you basically tell the IRS each year, we're following the rules. So that expense, there's folks that will do it cheaper. I hate to hold accountants to their fees, but whatever their accountant charges for those 2 returns is really the only expense that comes out of this each year.
Okay.
And that expense is tax deductible and would be paid out of the iCloud assets. I'll say there's folks that I would do it as low, and this is cheap, $750 a year. Most accountants will charge maybe between $1,000 and $2,000 to do those returns, unless you're in a big metropolitan area. And if someone's charging more than $2,500 to do those returns, quite frankly, I may upset some of my accounting friends, but there's companies that do those returns, and they do them. That's all they do for charitable families all over the country that will do it for a reduced fee.
Okay.
But those are the only filing requirements. If you live in New York, some states, there's some state filing requirements. Of course, you have your state income tax returns that the CPA will need to report that deduction. But that's it.
Okay.
That's it.
Okay.
So this is the last slide. Second to last slide. And we covered a lot of mountain tops there. And so I just go back. Income tax savings now for future annual gifts to charity. That's all this idea. That's the only thing that this menu item does for clients. That's it. No estate planning objectives, no asset protection objectives. It's just some people need to capture a big deduction for tax savings purposes this year for their future planned or what they're about to start doing in the form of charitable gifts. If anyone needs to contact me, of course you contact you, Kirk, but if they wanted to do some more exploring, there's some calculators, there's some forms, and there's some additional materials. But I'd be happy to email you this slide deck to share with any of your clients, Kirk, or if you wanted to, however you wanted to share some of the content, I'll make that available. But that's it.
Okay, great.
Unless you had some other questions you wanted to cover, and there are some common questions, but go ahead.
Yeah, Brad, I mean, if you could just give us an idea, so if somebody's going to work with you, kind of how do you approach it? What's the steps and how does that work?
Yeah. Thank you. Well, first off, almost all of my referrals come from folks like you. It's a very collaborative, advisory-centered engagement. They're not working with me. I'm in Florida. They're not working with me without their other advisors knowing what they're doing. Typically, we'll schedule a Zoom meeting or a telephone call, and we'll do a custom illustration, kind of like what this is. And then there's another diagram with the boxes and the arrows, and it's where we'll just have a Zoom. We'll go over an example, answer all the questions, no charge for that at all. And really quickly after that, the client, there's not a lot of moving parts here, and we'll either figure out if it's a good engagement or maybe something they want to pass on. But let's assume they want to move forward. I'll send an engagement letter. Your clients do engage me. It's a separate engagement letter where they're retaining my services, and I CC you and their other key advisors. It's very important that I like to get the CPA or the accountant or the enrolled agent, tax preparer, on the looking at this typically before an engagement letter is signed, so that we really know that this is the right fit. Sometimes their estate planning lawyer will get involved, and it's always nice when they say yes. This gentleman, Brad, is correct when he says this does not disrupt your estate plan. It doesn't. And we didn't spend time on that at all, but I can finish. I'll mention that real quick as we wrap up. But so if they want to move forward, typically, that's the intake. And then once they do it and they sign the engagement letter, my fees typically range between $5,000 and $10,000. Rarely do they get out of that realm. And $10,000 is really if we're getting more customized, or we're putting real estate or oil and gas or really non-liquid, complicated assets into the iClat. And that's an important point to make. It doesn't have to be cash and securities. It can be rental real estate. It could be oil and gas, stuff like that. And they'll pay half my fee when the engagement letter is signed. We get to work right away. The engagement's about 2 to 3 weeks. And at the end of that 2 to 3 week period, they'll have a signed iClat. We'll send it to them. They sign it with their folks or their bank, or they go to your office, Kirk. We'll get the EIN. And then the last part of my engagement, which is very important, is our team, our office gives them everything that their accountant will need to report correctly with the IRS that very big deduction. So the schedules, the calculations, these attachments, importantly, so their CPA doesn't have to go figure out what we did, which can be very stressful to CPAs. And lastly, the engagement. If the IRS asks any questions, my engagement includes up to 5 hours of my time to basically tell the IRS their own rules and to explain to them why this deduction was taken. We mentioned those 87,000 people that are being hired. It'd be interesting, well, not yet hired, but sometimes the computer algorithms, if they're used to the client sending in a 1040 with a $30,000 deduction, if all of a sudden that deduction is $400,000, the computers might spit a stupid computer-generated notice. The point is the CPA doesn't have to fool with that. That's my problem, and there's no charge for that. So that's the 4 corners of the engagement. I'm here if they need me during the term. If those questions are simple, I don't bill them for easy, simple questions. But sometimes people have very, very complex questions that might arise in year 7, like, I'm getting divorced. We need to.
Okay.
How is this impacted? Or or we want to put it into a very complicated private equity fund. We need to reinvest some of these assets. There'll be different fees for that, but that's it. So that's
Okay.
my lawyerly attempt to answer your question on fees and engagements in a short, condensed fashion. Um, and there's frequently asked questions on the website, but I kind of alluded to the death issue earlier. Very common question. I'll answer it very quickly. Again, if the client dies during the term, and I made this bold comment, it doesn't affect their estate plan. Whatever's in the iClat, whether it's this account or whatever, the assets at the end of the term will just flow into the client's will or revocable trust. Whatever, it kind of like a pour over will does for many of your clients.
Okay.
Whatever's left in this will just eventually flow into their normal estate planning documents.
Okay.
And the IRS does allow, if they follow the procedure, if the family wants to collapse the thing, they can collapse the thing. But I just wanted to mention that in case someone listens to this and say, he mentioned something about death and not affecting the estate plan. I don't get it. That's a very important thing for them to know, particularly if they're not in Florida. That's a common question their lawyer might ask. It will not disrupt their very good, maybe expensive estate planning documents that they have already put in place.
And if somebody's a California resident today, they get a nice big tax deduction, and they move to Florida a couple years later,
Yeah.
the state of California was probably not going to come after them, or
Oh, no.
Okay.
No, they won't. Not because of this, at least. Not because of this.
yeah, yeah,
They
Yeah.
might. I mean,
Yeah.
people are flying to Florida, and you've got clients in multiple states, but if I remember correctly,
yeah,
probably all over the country, Kirk. But yeah, the ones that are leaving New York and California and going to Florida or Texas,
it's happening quite a bit. Yeah,
it really is happening quite a bit. But
yeah.
Thank you for the opportunity to speak with you. It's a joy working with you and your clients, and just thank you for the opportunity to share this with you, Kirk, because the time is now. And I didn't take a summer vacation this year because I was trying to prevent people from saying, I'll just revisit that in October or November or December, waiting will pay for all the fees and then some. If they wait, that little 10,000 or whatever, 20,000 of lower tax savings is real money, and
Absolutely.
I wouldn't want anyone to have any surprises. So thanks for letting me talk to you in August, at this early point, of the year, as people start to think about their planning as we get into fourth quarter.
Yeah, absolutely. And I appreciate your time. And this is such a great strategy for a lot of people that they just don't know about. And especially, like you said, if they're charitable in nature to begin with.
Yeah.
So, as I said at the outset, we've done this for a couple clients of mine, and they both are really happy. And, I know when they get their tax return done, they were extremely happy. So,
Well,
So, yeah,
I say this, we pay our taxes, and not a lot of people, but usually there's something they like better than the IRS. I say colorfully. Usually there's something better or something more important to them and their family. So it is a tool that doesn't get a lot of attention. Kind of going back to that Ferrari analogy, people have heard about charitable lead trusts, and there's a myth that they're really just for ultra affluent, super uber wealthy, and more importantly, people that like to take a year off to do planning with crazy legal structures, and that's where they maybe have had a bad experience with it. So if any of your clients or people that see this say, I've heard of CLATs, and it was just a train wreck. I don't care what Kirk and Brad are saying.
yeah.
That's the Ferrari analogy, because you have to get an appraisal and you have to figure out how much is enough when the kids get it at the end of 10 years. And there's nothing wrong with that. It's just much more involved, and there's dozens of little crossroads where things will just go off the rails.
Okay.
You know, like a recession, or because you have to pick an asset that's going to skyrocket in value because you're trying to save estate taxes, and
Yeah.
it's just a very dynamic engagement that a lot of people have scars from, and that's why when you say CLAT or lead trust, they're like, "Ugh, yeah,
Yeah.
that's not in your best interest. You don't want to go there." But that's where my little Lexus or Corolla or Accord analogy, I try to. So you're in the minority, and your clients that are hearing about this, whether they, it's just a valuable tool to be aware of
Sure.
if certain situations arise, and it's a relatively non-disruptive tool compared to a lot of the other stuff.
Well,
We
well,
bring
one of
to
the big things, I talk about a lot with clients, like I mentioned earlier, so many people will use the 401k for their entire working career, and now they have a ton of deferred assets that are going to be taxed once they hit their RMDs. And with tax rates, I mean, the Trump tax bill is going to sunset at the end of 2025. I think no matter what, rates are going up. So, could be opportunity to take some money out now and ensure that later in life, you're going to be in a lower tax bracket or a more consistent tax bracket. And if you're already given charity, it could make a lot of sense.
Yeah, at a 30,000 foot level, all the iCloud is a tax mitigation tool that comes along those other discussions that you're having with your clients. Because you're right, I don't think income, I mean, the client may be in a lower bracket later, but if they've built up the brackets are going up, and the threshold amounts of income where people get into those higher brackets is going to go up.
Yeah.
And then you got that thing that Einstein called the most powerful thing in the universe called compounding interest. I mean,
Yeah.
the IRS knows that. They know they're going to get a
Sure.
buku bucks the longer you wait. So the question is, when, and all the deficits that we have. I mean, at some point, the IRS might accelerate this money. So they've already gotten rid of the stretch IRA. They're only letting
Yep.
people, and all that. So this tool just comes alongside those discussions, and deferred comp, which you're describing, 401ks, IRAs, executive compensation plans. I'd say that is the number one where fact situation of spike income that we come with. And there's a whole industry devoted to doing and strategic Roth conversions to play the bracket game. The iCloud allows more to come out faster.
Yeah.
And so
Yep.
K1 income, bonus income. Some people are just fortunate to have, hey, I got a bonus of $500,000 this year.
Yeah.
I don't
Yeah.
get too many of those, and but a few people do. But it doesn't have to be complicated deferred comp. You just get a bonus, incredible incentive, stock options. There's a lot of people that have phantom income because they just exercise something, and so that's where you keep this tool kind of in the back of your mind, that this might be a way to ease that pain. So
Yeah. Absolutely. Yep.
yeah.
Well, thanks again, Brad. I sincerely appreciate your time, and I'll make sure, show notes and everything like that, we put how they can, get access to you, find your site, your educational information, and
Absolutely, and if they do, I encourage them to have, in addition to you, Kirk, on the phone, and have and or their CPA. So it doesn't have to be. Some people like to get to know me first before they get all their other advisors, but the sooner everyone's on the phone, the better, and it's a very collaborative type of engagement. But I welcome any of those opportunities, and thanks again for the opportunity, Kirk.
absolutely. Well, take care, Brad. Appreciate it.
Thanks.